Simply central banks hiking rates, short-term rates, or lowering them does not, in and of itself, tighten or loosen money. It just changes the price of it. It doesn't have anything to do with tightening or loosening, which is about the availability and the presence and the creation of money. They're separate things. Because of everything that's gone on in 2022 and now in 2023, you hear renewed mantra crying, don't fight the Fed. And it's easy to understand why. I recall that saying, which actually in literature does go back into the 1940s, but not very commonly and not very widespread and not very accepted, is growing hugely in popularity in the 1960s with the television show led by Louis Rukeyser, Wall Street Week, and the regular appearances on it of Martin Zweig, who was a newsletter writer of some significance and also a money manager, not of terribly great significance. I don't want to get into criticizing Marty Zweig. That's not my purpose here. He's not been around for a long time. But he was this big table pounder on don't fight the Fed, don't fight the Fed, don't fight the Fed. And the concept behind that is when the Fed hikes rates, they're tightening. When they're loosening rates, they're loosening. And therefore, you should don't fight them. If they're raising rates, get on the sidelines. If they're losing rates, be in the market. This is one of those things that, like a lot of other broad pieces of long-term market lore, they lure you into doing things that don't really work all the time. Let me give you some examples of that. In my book, Debunkery, I have a long section. I mean, we're doing these regular debunkery things here. I have a long section, Debunkery number 28, on this topic. And first, I describe why it doesn't work. I'll come back to that. I mean, it works some of the time. Anything that's said like this has to work enough of the time that people keep saying it, but it's pretty 50-50. And then back over in the next 2 pages, I give you the actual data from when the book was written, about 10 years ago, a little over 10 years ago, showing you that it is 50-50. Now, 50-50 is a random phenomenon. It's not something that leads you to do well. The reason it doesn't really work is, and I've spoken about this so many times, so many ways, simply central banks hiking rates, short-term rates, or lowering them does not, in and of itself, tighten or loosen money. It just changes the price of it. It doesn't have anything to do with tightening or loosening, which is about the availability and the presence and the creation of money. They're separate things. You see that last year from the Fed doing what it's done, which you know, I'm not going to go back in detail over that because you do know that, you were there. And the fact that lending started the year with, in America, 4% growth rates and ended the year with overall year over year for the year, 12% growth rate. Boomed as they raised rates. You can't do that if they're really tightening money. You follow that logic? Bank can't keep lending at such robust levels if, in fact, they're tightening. Central bank's tightening. If it's really tight, if they're really trading tight money. Just high price, loose money. So then again, here's the data that shows that in the past, but I want you to think about current history because current history is good too. The Fed wasn't really going. In May, I point out that Jerome Powell said, as I've said many times before, that Jerome Powell said, we aren't even considering 75 basis point hikes. Then in June, they rose rates overnight lending rates by 75 basis points. The next meeting, 75 basis points. The next meeting, 75 basis points. The next meeting, 75 basis points. He said that in May. Market fell to October. They're still raising rates. Where are we now in the market? We're where we were in May. You follow that? Now, let me take you through that. If don't fight the Fed worked, you should have gotten out of the market then and not gotten back in. In fact, it worked from May to June to July to August to September, 4 months. May to June, July, August, September. Didn't work October, November, January, February, 4 months. There you go, back to 50-50. That's my point. I'm not suggesting you should do the reverse of fight the Fed. I'm not suggesting, I think you need to not think of them raising rates, short rates, the way they do, as necessarily tightening money or loosening money. You need to have a more fundamental concept of what actually is going on in banking and in capital markets. Thank you for listening to me. I very much hope you enjoyed this video as part of my series on debunking common market myths. To watch more videos like this, click the link on the screen and make sure to subscribe to Fisher Investments YouTube channel. Thanks so much for listening to me.